Thank you, everybody, for being here tonight. This is the webinar on creative giving solutions, a presentation to CAPE, donors, friends, family, board members of our organization. My name is Paul Rigby. I have been a member of the board of directors of CAPE somewhere between 8 and 10 years, and I get to either give credit to or blame Paul Milano for getting me on the board. Thank you, Paul. I served as the treasurer for a few years and finance committee chair, and I marched in the Cavaliers, DCI year number one, 1972. And again, Paul Milano was in the drum line. Chris Hardowitz was in the rifle guard. So lots of good memories for the Cavaliers. More recently, I've been doing some work with an organization called the National Christian Foundation. We are specialists in creative giving solutions. I'll talk a little bit more about us in a minute, but I first want to just spend a couple of minutes talking about what we'll cover in this presentation. Since the title of this webinar is Giving Solutions, it's solutions to what? There's a problem that I want to address around giving. And when I talk about the giving problem, you begin to see what we're headed towards in terms of what these solutions are going to look like. I will also give a framework for basically the underlying principles for these solutions, and I'll give some specific examples near the end so that you can all be thinking about how these might apply to you. I'm also going to spend a few minutes talking about IRA distributions, but I'm going to say now I'm not an expert in IRAs. And when I get to that section, these will be some thoughts I've got, some things I know, but I would strongly urge you to consult with a financial advisor and not take anything that I say as advice. Also want to mention what this is not. This is not intended to be an appeal to any of you on the call tonight. This is not an appeal for more funding on your part. We don't need you to give more on this call. I'm going to leave it up to Scott, to Robert, to Daniel, to Chris and Dale. They can do the fundraising appeals. This is not at all intended to be an appeal. It's simply to inform you about some ways that you can maximize your giving potential with what you have already. Okay, Scott, let's move to the next slide. Okay, this is a little bit about the National Christian Foundation. And this is not intended to be a commercial plug in any way, but I wanted to share some statistics with you so that you can understand why we have some credibility through the experience in giving solutions. We were started in 1982. We are focusing on Christians, but we are not exclusive to Christians. And if I can point out to you over on the right side, some of the statistics, the one I think that we would say we're most proud of is the $20 billion plus that we've granted out to various charities, ministries, and churches since our inception. There's 90,000 different charities that are part of our network, and CAPE happens to be one of them. Okay, Scott, let's move on. So let's get right into what we think is the giving problem. So on the left side here, you're going to see this circle graph. It's going to show this. Basically, this is a composition of average household, the balance sheets of average households. The statistics are taken from 2022 by the IRS, and we've looked at these numbers over a range of years. They just haven't changed. But what that is showing you that the average household balance sheet, 10% is held in cash, and the rest, 90%, is non-cash. In the next slide or so, we'll go over what some of those other categories are. But just I want you to picture that 10% is in cash. Think about your own situation, your entire portfolio of wealth and assets, how much is in cash. But on average, it's 10%. Let's move to the right side here, and that circle graph tells us this is the composition of charitable giving across the whole country in this year. You can see the composition is radically different Over 75% of charitable contributions are in cash, and less than 25% is in non-cash assets. So there's a giving problem, and I would say that there's an asking problem as well, because I think far too many charities have not focused themselves on working with their donors on how can we unleash that 90% that's non-cash. In fact, Scott, let's go ahead to the next slide. This is just a different way of showing this. It's a picture. If some of you graphic just learn better by looking at a picture, there's an iceberg. The top part, the tip of the iceberg would represent cash. And of course, it's the smallest part of the iceberg, and the bottom would be different elements of non-cash. And of course, it's just trying to depict the same thing in a picture form. But we did list out here, here are some of the non-cash giving opportunities that we've experienced over the years. Publicly traded securities, which we'll talk more about in detail later, closely held businesses, real estate, intellectual property. I'd also put up here cryptocurrencies, commodities are also examples of non-cash giving opportunities. Okay, Scott. Okay, so this is our challenge tonight. We want to talk about how do we unlock that 90%. So again, we have the different categories of non-cash assets on the left. You have National Christian Foundation or any sponsor of creative giving solutions in the middle. And of course, you have the charities on the right-hand side. CAPE would be one of those. So our challenge is to do that. Okay, Scott, let's go to the next one. Now I'm going to start talking a little bit about the solutions. And when I talk about the solutions, I want to just from a very high level, there's an underlying concept or principle that we're going to be talking about here. Giving more with non-cash, and I should add appreciated assets is kind of the first thing we're going to look at. Giving more with non-cash appreciated assets. And basically what we're doing is we're converting tax dollars to giving dollars. So all our solutions are basically tied around that. If you look at this circle graph, this would represent just the different outflows of our money. Where do we spend our money? And it's not intended to be these are specific for any particular family, but it represents that a good portion of our spending goes to savings, investments, lifestyle. There's a portion for taxes, there's a portion for giving. Everybody on this call, as a donor to CAPE and probably other charities, you have you have a giving bucket as part of your your family strategy for finances. There is a giving portion, but the underlying concept here is that our goal is to convert some tax dollars over into the giving bucket. Tax dollars to the giving bucket. So when I start talking a little bit about tax strategies, I need to mention something here that there's basically three types of tax strategies. The first is deferral, tax deferral. So if you think about most retirement strategies, retirement accounts, it basically is just you're making a non-cash investment in a non-tax investment, and then you're going to pay that tax a later point in life, hopefully at a time that you're in a lower tax bracket, but you're just simply deferring it to a later point in time. The second type of strategy would be called tax avoidance. And here, the tax code permits certain structures of transactions that you either reduce permanently or eliminate the tax entirely. That's tax avoidance. The third strategy is called tax evasion. That's a felony, and that's not what we're going to be talking about tonight. We're going to focus our attention on tax avoidance. Okay, Scott. So we started with the idea of we're looking at non-cash appreciated assets. And then I'm gonna throw in another concept here, and that's the difference between selling an asset and giving the proceeds to a charity, or actually giving that asset to the charity and let the charity sell it. So I've got the next three slides are going to show the differences between the two, and you'll start to grasp the really the power and the leveraging of a give first strategy. So this example here, the assumptions, there's an asset that has a fair market value of about $300,000. It could be any non-cash asset. The original cost was 50,000. So what you have here is you've got a gain of $250,000 in appreciation. And then we're going to assume that the giver wants to give 100%. It just makes the example simpler. 37% ordinary income tax rate and a 20% capital gains tax rate. Now, many of you are in states where the state also has a capital gains tax. Illinois, for example, has a 5% capital gains tax. So your actual tax liability would be calculated based on 25%, not just 20. So in this example, the fair market value, 300,000, it's sold. So the first thing that happens though, there is a capital gains tax liability of 50,000 that goes to the IRS, to Uncle Sam. So the amount that actually is available for this giver to give to his charity after that initial tax is only $250,000. But he wants to give 100%, so he does that, and he's going to get an income tax deduction for making that gift of now cash, after tax cash of 250, and he'll get a tax credit of $93,000, which is the 37% applied to the 250. So kind of just look at those numbers and you can see that that's still a very generous gift on the part of this giver, but Uncle Sam got that capital gains tax. Okay, Scott, next one. Same assumptions in this example, but in this case, the giver is going to adopt a give first strategy and then he'll give it to the charity and the charity's going to sell it. You can see in this example what happens. $300,000 fair market value gets transferred to the charity sells it, but the charity is a 501c3, and the 501c3 is exempt from paying capital gains tax. So this is a perfectly legitimate tax avoidance strategy. So the benefit here is that now $300,000 is in the hands of the charity. The individual giver, when you look at their income tax deduction is 37% against the fair market value gift of 300,000. And so they now have a net benefit by reducing their taxes of $111,000. Okay, Scott, next slide. So this compares the two. Same assumptions on the left, but you can see the impact of combining appreciated non-cash asset giving before you sell to the charity, and there's a $69,000 less in taxes by a give first strategy, which means 50,000 to the charity and the remaining portion goes to the family. I don't know about you, but this is not small change. This is really can be impactful to that particular charity to go from 250 or to a number of charities, 250 up to 300,000. Okay, Scott, could you go back about 3 or 4 slides to the unlocking the 90%? Sorry, I'm taxing your, there you go. Thank you. I kind of threw a little audible here. So we've talked about the two concepts of it's an appreciated non-cash asset. We want to give first before we sell. But see, we've got another problem that creeps up here. The charity on the right, I don't know about you, many of them cannot even accept a stock gift, let alone a gift of real estate, a gift of partial interest in a business, any other restricted securities. There are many charities that can do appreciated stock. For example, Cape, we can take stock gifts in. We've got a brokerage account, but I know many aren't able to do. So we have a second problem that we need to get through. And so Scott, move ahead, go back to where we were. Keep going. Keep going.
Paul, we do have a quick note here from other Paul. Paul
Sure.
Malone.
Let's go ahead and take the question.
Yeah, it's kind of more of a note. He says, and I believe the donor can spread that income tax savings, 111,000 over 6 years if they can't use it all in the first year.
Absolutely. It's a great observation. If you can't take it all in the year that the gift is made, it's basically 1 year plus five. So that's 6 years that you could apply it over. You basically can carry it forward. Okay. Any other questions, Marie?
Nothing yet, but yeah, as anytime a question comes to mind, anyone feel free to drop it in the chat and we're happy to kind of answer as we go along here. This can be interactive. So feel free.
Scott, would you go on to the next slide, please? Thank you. So I want to introduce the idea of a donor advised fund or a DAF. At National Christian Foundation, we call it a giving fund. So for the rest of our conversation tonight, if I say giving fund, if I say donor advised fund, if I say DAF, they're all the one and the same thing. And I'll try and use DAF, but forgive me, I'm gonna use all three. So a donor advised fund. What is a donor advised fund? You can think of it as a charitable checking account. Uh, I'm presuming all of us have a checking account with a bank. These are typically FDIC member banks. You put cash in and you have a nice big balance there, and then you're able to write checks or send transfers or ACH, use your debit card to all the various stores, vendors that you might come in contact with. Well, a donor advised fund is similar, that you open up an account, but it's not with a FDIC member bank. It's with a 501(c)(3) DAF sponsor, donor advised fund sponsor. National Christian Foundation is a DAF sponsor. Schwab, Fidelity, Vanguard all have DAF sponsor organizations. And there are dozens and dozens of local community development organizations that also are DAF sponsors. So there are plenty of options for DAF sponsors for you to open an account. So the same idea that I mentioned before, where you can donate cash or you can donate a non-cash asset into your donor advised fund, your charitable checking account, and bingo, right away, you're going to get a tax deduction, a credit against your taxable income for the fair market value of that gift, whether it's cash or it's non-cash. So now you're sitting with, and if it's non-cash, the charity will sell it eventually, and then you're sitting with a pool of cash in your donor advised fund. You have the option to have the DAF sponsor invest that money so it can grow over time. Now, any type of earnings that are attributed to the growth of the DAF, it doesn't leave the DAF come back to you, but it's more money that's available for your favorite charities. Now that you've got a balance in your donor advised fund, then you could recommend grants. Mainly, you can do it online. It's the easiest way to do it that we know, and you can do this over time. There are no restrictions. There's nothing annually or over a year's period that dictates how that you have to pay the money out. You can recommend to as many charities as you want, or you can do it to one. So these are the features of a donor advised fund. I do want to pause now and just say, are there any questions about this before we go any further about just some of the features of a DAF? Marie, anything? Okay, Scott, let's go to the next slide. So I want to talk about some of the key benefits of a DAF. And when I do this, I will mention there's certain characteristics of donors that I'll attach to each of these benefits. This will become a little clear as I go on, but the first benefit is that it's a very simple, efficient, and convenient process to operate a DAF. And this primarily is for somebody that gives to multiple charities. If you're not using a DAF, I'm sure you're all familiar with, you've got to track down all the receipts that come from the different charities, keep track of when I made the gift, the grant, there's just a lot of complications, a lot of paperwork Your DAF sponsor takes care of all of this online. You make you can make 2 or 3 large gifts into the DAF, and you can make 100 grants out of it, and it's all kept track of for you on an automated basis. There's a report that will be, complete or compiled at the end of the year by the DAF sponsor, and you can simply attach that to your tax return that can be used as, "This is the amount of, charitable contributions that I've made that can apply against my taxable income." So that's just a huge benefit, but mainly that applies for people that have more complexity with their giving, meaning more charities that they support. The second one, that's decoupling the tax strategy from the giving strategy. And where that really is most applicable, there are some folks that their incomes, I'll characterize it as either it's irregular or lumpy, meaning in some years they might have just a huge commission. Their particular marketplace is booming, and they're going to reap the benefits of that. And in those years, they might want to take a much larger amount of money, put it into their DAF, and get the charitable deduction to help manage their taxable income and the taxes that they pay. So then you're going to have lean years that maybe you're not going to have as much income, and you might even, in some cases, you might go from itemized to standard deduction, and you're not going to have as much that is going to go into your DAF. But you're sitting here with a giving strategy because in those prosperous years you've put money in, you can set up a giving strategy that's going to be consistent for a 5 to 10 year period and not make the various charities kind of penalized by, oh gosh, Paul had a great year this year, but Paul didn't have a so good a year this year. So his giving goes up, his give. No, you can decouple your tax and your income strategy with the giving strategy so you can align your giving strategy to however you want to do it. You don't have to do it this way, but it gives you the flexibility to do that. And for some folks that do want to have more consistency and be a consistent supporter of their charities, a DAF provides that opportunity. I did see a question, Marie, that came up.
Yes. What about those who have a required minimum distribution or RMD? Are these distributions able to be put into a DAF?
Okay, I will get into that later.
Okay.
Okay. Uh, the short answer is no, but there is a vehicle similar to a DAF that they can be used for. Okay, so the other thing that's important, another thing important for givers is anonymity. With a DAF, if you want to be anonymous, you can do that way. So National Christian Foundation, when I make a grant to CAPE or my church or whomever, I'm given an opportunity. I just check a box if I want it to be anonymous. And so then when that check or ACH goes out, it simply says it's from the National Christian Foundation and my name's never attached to it. For some people, this is important. It's not important for everybody, but with most DAF sponsors give you the ability to make it anonymous. Ability to process non-cash asset gifts. This really applies to people that have an upcoming liquidity event, people that want to give out of maybe their investment portfolios, or they have a lot of real estate that they want to use as a gift. The ability for the DAF sponsor to process that, again, going back to it's a non-cash appreciated asset. I want to give first. I can put it into my DAF. I can work with the DAF sponsor to sell it and liquidate it. And the DAF is the right vehicle to do it so that the charity is not involved in that processing. They'll just wait at the end for the proceeds to come out and be granted to them. And then, of course, the final benefit I want to mention, you can make your grants over time, and that time is what you dictate. It's not dictated for you. Just a side note, some folks that have lots of wealth do they do create a private family foundation. One of the restrictions of a family foundation, and it's not a huge restriction, and I believe it's 5%, but there's some percentage that's a single digit that has to be given each year, and you can't sit on that. Currently, there are no similar restrictions with a DAF. And right now, there is nothing that we see that's before Congress that would change that. I'm not promising that it would ever change, But currently, the rules are you can make grants over time, really according to how you want to do that. Scott, go ahead to the next one. So I've already mentioned this, but just to kind of highlight, and I want you to, I'm going through this, think about your own situation. These are the kind of the characteristics or conditions that really lend themselves to reap the benefits of a DAF. And as I said earlier, if you're giving to multiple charities, you have irregular or lumpy income, you have a large non-cash, probably an investment portfolio that really goes up and down with the market, or you have a business interest, you own a small or private business, and you've got an upcoming liquidity event. All these make are great attributes to be opening up and considering a DAF. Okay, Scott, let's go to the next slide. So, as I mentioned earlier, I want to talk a little bit more, take a little deeper dive into giving of appreciated stocks. The reason I want to do that, it's probably the simplest form of a non-cash gift to explain, and it's probably the simplest to understand. Also, this is probably where there's the lowest hanging fruit for people that are on this call, and particularly for CAPE, to ask donors to consider, because people can simply look at their portfolio. Doing some of the other asset categories, real estate, business interest, they can take a little longer to do, and we're now into October. They can be done, but appreciated stock is the simplest and the easiest to do. And also, when you think through what are the underlying kind of the concepts, the principles, it applies across all the asset categories. So how does it work? You donate long-term appreciated stocks into your DAF before you sell. Again, give before you sell, and it's an appreciated asset. For most brokerage firms, you simply send them a letter and you give that they probably have a template, a form that you fill out. It will identify certain account numbers. You'll have an account number of your DAF sponsor, the number of shares, the ticker symbol of the stock itself. Uh, I use JP Morgan for mine, and I've got the setup to go. I just fill in a couple of blanks. I send it to my broker. He then transfers the shares over to the DAF sponsor. DAF sponsor sees it. They know it's coming to my giving fund. They liquidate the shares, and within 2 days, there's cash in my DAF. It's a very simple process. And really, the only thing I need to do is that I need to send that letter, some communication that's an official request of my broker to move the money into my DAF. And then, of course, I have money that's available to give to my charities over time. Now, the middle bullet point here is that then I receive the income tax deduction and I reduce or eliminate the capital gains tax by using appreciated stock, giving it before I sell it, and using my DAF.
I'll
Okay,
have a quick question here.
sure. Yep.
Would you recommend having the funds you contribute to a DAF invested for potential growth or kept in cash for security?
As you set up your own IRA, you can do both. In fact, most DAF sponsors are going to not permit you to have 100% of that fund balance in some kind of growth because you're going to want to make sure you've got some liquidity to make grants. I would say, again, just personal advice, and you might want to talk to your financial advisor, but we normally recommend that you look at what might be an approximate amount that you're going to want to grant out in this year, keep that in cash, and then everything above that amount that you can invest. And we have 3 or 4 different, ranging from very conservative to very, I wouldn't say risky, but much less conservative. And the DAF sponsors, particularly the large brokerage houses that have DAF sponsors, they will have different options for you. But typically, I don't recommend you do all one or the other. And if it's a fairly large amount in the fund balance, I would say keep some liquid and then keep some and permit it to to grow over time. I would also say, and this is going to kind of be uh, Creative Giving Solutions 201, not 101, you can actually make investments out of a DAF into for-profit entities. There are DAF sponsors that specialize in for-profit investing. So you can move money out of your DAF, and it's called impact investing. And you can actually invest it. It's not a contribution. So if that for-profit entity makes money and they have a distribution, it comes back to your donor advised fund. So there's a lot of things that can be done with a DAF that can kind of help that return. Paul, that's kind of, I think, your question. You want to have liquidity, but you can also get a good return out of it. And all that return just creates more money available for your favorite charities in the future. Does that answer your question, Paul? Okay. Okay, Scott, let's move on. So the key benefits here, the first and foremost, we're freeing up more giving potential to your favorite charities. That's, again, this is kind of the whole premise of what we want to do here is identify opportunities to maximize your charitable giving and giving appreciated stocks. This is the first benefit that you're going to see. The tax efficiency of this, when you couple the income tax deduction and the capital gains tax, either reduction or elimination, you deduct now, you grant later. And again, as I outlined, it's a very simple and convenient process. Okay, Scott, let's go to the next one. So I just want to summarize this portion of the webinar in talking about, again, the concept of how can we maximize our giving through non-cash assets. We need to consider those appreciated assets on our balance sheet, a give first, then sell strategy, use a donor advised fund. You'll get a fair market value charitable deduction at the time of the gift. And when you couple that with the capital gains reduction or elimination, it's an incredible amount of money, more money available for your favorite charities and money for your family as well. Now, I want to take a pause for a minute and just explain a couple of differences between giving appreciated stock and giving some of the other assets. We actually call those other asset gifts complex asset gifts because there is more complexity to them. And there's a couple of areas where it becomes more complex. So the middle bullet point here, the fair market value of your charitable deduction. For a listed security, it's very easy to calculate what is the fair market value because it's the market price. It's on a registered exchange. Your broker has the price. The DAF sponsor can get the price. It's a known entity what that fair market value price is. When you get into real estate or business interests, you have to come up with a different methodology, and that gets more complex. But all of these other assets, there's some form of an appraisal that's done, and the appraisal is done by a qualified appraiser. The IRS has definition by each of the asset categories who qualifies as a qualified appraiser. But it's really important to make sure that this gift is actually allowed by the IRS, that you follow those rules about who can actually make the appraisal to determine the fair market value. The second thing has to do with just the nature, the ownership structure of the particular asset. So it could be held as an LLC, it could be a partnership in trust, C Corp, S Corp. There's many, many different structures. Each of those structures is doable, but each of those structures, there's just different IRS rules for how you actually transfer from the giver to the charity. And so that we want to make sure, and we have experts in our head office that this is what they do every day, is make sure that this is handled absolutely by the rules. Otherwise, you could have a gift that gets disqualified. So again, there are some differences. Appreciated stock not only is the low-hanging fruit, but it's the simplest to do. The other assets are more complex, but they're definitely doable. And working with DAF sponsors that have experience in this can make it actually a very simple, easy process for you. Any other questions, Bree, before I go on?
Not yet.
Okay, Scott, let's keep it here because I don't have any slides about the IRA distribution. Our firm actually frowns on me making presentations and talking about areas where I'm not licensed or registered. So I'm very comfortable with the slides I've given you. Uh, and again, I'm going to repeat the caveat. You really should talk to your financial advisor when thinking about all your IRA deductions. And if you've got a tax advisor or accountant, you want to include them in this conversation as well. But since I slept at a Holiday Inn Express last night, I'm going to go ahead and give you my thoughts about two forms of IRA distributions. The first is the qualified charitable distribution, commonly called a QCD. So this is a permission by the IRS to actually, when you get to a certain age, 70 and a half, that when you start making any distribution out of of a traditional IRA, I'm not speaking of a Roth IRA, but a traditional IRA, the tax has been deferred. But when you make a distribution out of that, the IRS is saying it's our turn. We want that tax. But they've made an allowance again for just over the need for philanthropy in our country, that there is a tax benefit if you use a QCD. And basically what a QCD is, you designate one time a year, it's per taxpayer, to a single charity, an amount up to $105,000 this year, and it's going to be graduated up based on inflation. You designate a particular charity, and you can make a contribution from your IRA directly to that charity, and the distribution does not count against your taxable income. So that's the tax benefit. It's not a tax credit, but it's just not going to count against your taxable income. A regular distribution will count against your adjusted gross income. So again, you've got a single charity that will be the beneficiary. Now, I believe there was a question about making a donation of your any IRA distribution into your DAF. A QCD cannot go into a DAF. But one of the things that you can do, and most DAF sponsors do offer these services, you can set up a designated fund alongside your DAF. And the designated fund, basically there's only one receiver, one charity that's going to receive those proceeds. But instead of giving the QCD directly to the charity, you put it into the designated fund, and then you can grant over time at whatever pace and the dollar amounts until that fund is depleted to that particular charity. So there are some DAF-like characteristics, particularly you put the funds in and then you grant over time that would be similar to a DAF, but you can't make grants to multiple charities out of a QCD. Now, I don't know if there's any RIAs that are in the room tonight. If there are, please raise your hand, and you're going to be the expert more than I am. And correct me if I've said anything that's not incorrect, but I believe this is the kind of the going practice. And one of the complications to this, the IRS sets the rules, but they also change the rules pretty regularly. So the RIAs, the registered investment advisors, stay up with this pretty regularly. So let me now talk about the second distribution, and
Paul,
that's,
sorry, we do have
oh,
another
yep,
quick question, so sorry.
okay.
Um, whether your organization, Paul, or another DAF sponsoring organization, is the process of setting up the DAF a relatively easy process? And how long does it generally take to set up?
It's a very simple process. You could set one up, and almost all of them, you can do it online. In fact, at National Christian Foundation, you can do the whole process online. And if you're pretty astute with these things, it's probably 15 minutes and it's done. But we're a little different. We have a concierge service, so we actually have people that you can call if you need help setting it up and wanting to make sure. There's things like you can set up a succession plan for when you're no longer around, and you can set up a succession plan around your DAF. There's other things that are deeper levels of complexity, but again, it's to set up a basic DAF is 15 minutes would be, I would say, at the most. And all the others, they specialize in online. In fact, if you want to get a live person at Schwab, Fidelity, or Vanguard, it's hard to get a live person because they're all about it's low cost, it's just a very efficient online transaction. And they actually don't specialize in the complex gifts as donations as much. But again, it's a very simple process. I would say 15 minutes at most. Does that help? Okay. So back to the RMD, the required minimum. Again, different set of rules. And when I get to the end here, I'll explain there is some overlap between the two. But for purposes now, the RMD, it kicks in at age 73 now. It was raised. It's now at 73. There's a formula that the IRS has. It's based on your life expectancy at whatever age that you're looking at. So at 73, there's a life expectancy. At age 74, it's different. You apply that rate to the balance in your IRA, and then that will dictate what your RMD is going to be for that year. And of course, then you need to make that distribution. And under normal circumstances, that RMD then is added to your taxable income. Now, where the two come together is that you can actually use the QCD, which is the qualified charitable distribution. You can use that and count that towards your RMD. So that if you don't want to, if you don't need that required distribution for your own personal income, you can substitute the QCD for that amount. And then of course that it's not added to your taxable income. And then, of course, the rules then for a QCD in terms, you either give it to a single charity or you put it into a designated fund, and it still goes to that same charity, but you can make grants over time. Does that make sense? RMD, different from a QCD, but you can use a QCD to kind of satisfy the RMD requirements. Lots of acronyms. Again, qualified charitable distribution, required minimum distribution. It's complicated. That's why you need a RIA and a financial pro to work through this with you. But again, it's when you start getting close to thinking about your IRA distributions, it really is worthwhile because they can be very, and many of our givers, and I'd say most, they do incorporate their QCDs into their giving strategy. And then they'll look at, okay, so what is left in terms of taxable income against which I can take some deductions for charitable purposes. So again, a financial advisor can help you think through the various buckets here from the RMD to the QCD to all your other non-cash assets. Any other questions about IRA distributions? Okay, so let's go back and I'm going to really close with this slide here as our key takeaway. Scott, go back one, please. Yeah, sorry. Again, just to repeat, and the reason I do this is that, um, I know I have a good memory, but sometimes it leaks. And so repeating things over a couple of times, these are the takeaways that you really need to be thinking about as you examine your own personal balance sheet. There may be opportunities for you. Some might be low-hanging fruit. Some might be events that are coming up that are going to really maximize your giving potential. And again, it starts with looking at appreciated non-cash assets. Remember to think about giving first, then selling. Use a DAF, a donor advised fund. You'll get the fair market value charitable deduction in the year that you make the gift. And when you couple that with capital gains tax reduction or elimination, you create a boatload more money available to your favorite charities, including CAPE, and then more to your family as well. So that completes my presentation. I will stay on for more questions. And there's my contact information. I also have a cavaliers.org email address. I have a Gmail address, so you can contact me any one of these, and this is my phone number. Any questions that you've got, I'd be happy to answer them. And also, if some of you are using a brokerage firm that uses a DAF sponsor that's not the National Christian Foundation, I'm happy to answer your questions and walk through different scenarios with you. We'd be happy to help you just even do some illustrations of various gifts. Our purpose is not to make money. We're a not-for-profit. Our purpose is just we want more giving, and we want more funds available to favorite charities. And however we do it, if it's through us, that's great. If it's not, that still helps accomplish our mission. Paul, you got a question, or are you saying bye?
No, I may have missed it. Um, when you set up a DAF, unlike some other charitable opportunities like this where you have to, it's a lump sum and you can't add to it. Can you add to a DAF over time? If you said that, I missed it. Like
Yes.
every year, add 5 or 10,000 if you don't have a big chunk to start out with.
You can add at any time. You can add to your DAF. That's where it behaves like a checking account. A checking account. You can add to it at any point in time. So the stock market's going up and you want to take some money out of your portfolio and put some in your DAF. You can do that at any time of the year. You can time it. And actually, one of the beauties of it is that you don't have to time it at, the last half of December. You can time it throughout the year, multiple gifts into it, and then of course multiple grants out of it.
Thank you.